Well, hi, ladies and gentlemen. My name's Chris Weston. I'm at Pepperstone, and we're joined by my colleague, Luke Suddards, who's based in London. We're going to be talking about what is effectively, I want to call it Super Thursday or Super Central Bank Week or whatever the coin of the phrase. But we're in for a mammoth in terms of, a behemoth in terms of event risk, and traders are going to have to navigate that, whether it's the FED meeting, whether it's the Bank of England meeting, whether it's the ECB meeting. We could even throw in the Norges Bank as well, which could be quite an interesting scenario if they decide to leave rates on hold. Market's pricing about 19 basis points of hikes there. If they do leave rates on hold, that could have some big vol in the Noki. But we're in an interesting time in markets as well, with big volatility playing through in the NASDAQ and tech stocks. We're seeing some movement in fixed income. Oil markets are pretty lively. So it's a really good time just as we're heading into the end of the year. Once we get through this week, perhaps we can get a rally into year end. We'll have to see. Maybe people roll the roost under the market and decide to call it that for the year. But let's crack on with we've talking about these three major central banks, which, you know, whether you're trading the dollar, whether you're trading gold, whether you're trading equities, yeah, they could really touch all various factors within the market. So I think it's a really good idea to bring Luke and myself into the conversation, just to sort of talk about what the market's expecting, the kind of volatility we're seeing there. So welcome, Luke. How are you going over in London? Is everything all right?
Yeah, it's good. A bit concerned about how things are turning out with Omicron and potentially pubs being closed around this time of the year. But we're keeping on, and we've got a close eye, particularly from our trading desk, on the BOE and the ECB. But I think we'll kick things off with you on the Fed. I know you've been looking at that. So, you know, we've obviously been seeing a lot of questions about, can the Fed be blamed for falling behind the curve and allowing inflation and not being more proactive? So what are your thoughts on that, Westy?
Well, I mean, I think they've obviously pivoted really hard last month or so, and you know, you've seen even like Powell very much getting on board, losing the transitory mantra. The irony is now that you've probably seen peak inflation coming through. You know, people like Kevin Walsh in the Wall Street Journal and Mohamed El-Erian saying that the Fed, the transitory call was the worst call the Fed have ever made. So certainly they're getting a bit of abuse, and they're getting some pressure from Democrats as well, sort of moderate Democrats. So yeah, there's elements of truth to this. I mean, my job as a trader is to try and make money out of volatility in the markets and movement in the markets. So it really doesn't concern me if the Fed are behind the curve. I don't necessarily think they are, but a lot of people do believe that we may be setting ourselves up for a policy mistake. You know, I think that the low 10-year yield, for example, is just a reflection that markets are seeing slower growth in the future. I don't think necessarily that I sit in the policy camp, in the policy mistake camp, but I know a lot of people are. Look, I mean, I think it's difficult to say that the COVID variants and the COVID situation was ultimately why we're seeing inflation. So that is ultimately where we are, and no one could have foreseen that situation. Then you mix that with huge fiscal stimulus, with monetary stimulus, and that's where you get this huge aggregate demand and bottlenecks, and it's this cacophony of inflation forces that we see the highest level since 1982. And we're going to see core PCE coming out on the 24th of December, and that's going to be somewhere around about 4.8%, which would be the highest level of PCE since 1989. But yeah, I think the Fed are part of the reason behind this. I don't necessarily think QE has generated huge inflation, but what we've never seen is this massive stimulus from fiscal running concurrently with monetary policy. So I think the Fed are partly to blame, but I think, you know, I actually sit in the camp that the Fed did what they had to do given the circumstances. So I'm not too concerned about, you know, whether they're to blame or not. It's creating volatility now, and that's the most important thing for traders. What do you think?
Well, yeah, I agree with you. I think there's also a delay and a lag with monetary policy, and the worst thing that they could do is jump the gun and act too early when inflationary pressures, although could remain slightly elevated, slightly longer, but will likely decline and take on a humped shape. But speaking of volatility, which I know is very important to Pepperstone clients, on a scale of 1 to 10, what do you see this Fed meeting tomorrow as? Is it likely to be, obviously at the end of the extreme 10, massive volatility? Does it have the possibility to really catalyze a move in markets?
Well, it definitely does. We've seen previous Fed meetings cause big volatility, but I think, given liquidity as well, you're talking about top of book liquidity being fairly poor at the moment. You know, a lot of the institutional traders are talking about that. The ability to get in and out at the quoted price and size is, you know, something that's deteriorating, and that can exacerbate moves. And that's something across asset class that we do need to be concerned with. And, you know, we're always prone to some sort of communication error that could come through. And obviously Powell will have to try and clear that up and try and get that through. But yeah, like I think in terms of the ECB meeting, the Bank of England and the FED meeting, of course, the FED are the world's price maker effectively in terms of those central banks. And so that, yeah, if the market is surprised, and we have our checklists and playbooks by which you say we can be surprised, then of course, you know, of the three central banks, for me, I know you may disagree with this, but I think if they were to really surprise the market, then you're going to see a more broader move across asset classes than you would do in, you know, say the ECB meeting, which may be more idiosyncratic to EU assets. You know, if the dollar is going to have a move, if US Treasuries are going to have a move, it's going to manifest into moves across markets. You know, so I sit in the camp to answer your question. Sorry, it's yeah, I think the possibility is probably around an 8. If the market is surprised, we could see some big movement coming through. I'm not so sure we are going to get hugely surprised. I think a lot of the stuff will come out as expected, which we can talk about in a moment. But yeah, has it got the ability to surprise? And as traders, do we need to think about our risk management? Absolutely. And I think that's what we're seeing in the market at the moment. I think, you know, the moves in the NASDAQ, the moves that we're seeing in treasuries are people pre-positioning ahead of what could be, what is a huge volatility event. So what do you think?
Yeah, I think I'm more interested in your view on where you think that volatility could actually come from. For me, I think it's if we get a number outside of that range that the market's expecting on the tapering side. Market's expecting 25 billion to 30 bill a month. That would obviously end the program around March and open up potentially an earlier rate hike than what we were seeing towards the beginning of this year, September. It got brought forward from December, September, and now we're at June. So I think that could move the market. And then obviously dot plots, maybe 75 basis points for 2022 instead of 50, and maybe more talk about fears over inflation. But where do you think the vol is going to come from, Westy?
Well, I think that the Fed have got to balance this idea between what's obviously a better quarter of Q4. We are seeing a better Q4. I mean, the Atlanta Fed numbers on the nowcast are something like 8% or so, whether it comes out those numbers. We are going to see a better Q4 at the time when Omicron's obviously, you know, starting to influence, and the cases are obviously increasing, and we still don't know a huge amount about it, and that will enough to really price risk around. But, you know, I'm going to share my screen quickly. And go to what I think is really important there. You should be able to see US Treasury markets. Now, if you're trading the dollar, if you're trading gold, if you're trading the NASDAQ, and certainly these markets.
I don't think I can see it, Westy. Just
so I've got 2-year yields. I think they're really important. So where do we get a move? And I think the first derivative of this is going to come in the rates market and the front end of the US Treasury curve. Look, I think there are people out there who think in 2022 that we're going to get 4, maybe even 6 rate hikes from the Fed, as they have to really deal with the situation and get in front of the curve effectively. There are people out there who, like Bill Dudley, for example, from the ex-New York Fed president, who's sort of been writing for Bloomberg, op-edding there, saying that the Fed are going to have to be more aggressive than what some people are expecting. If the Fed now come out and say for the dot plot projections, these are the economic, the projections on the Fed funds for 2022, 23, 24 in the long run. The wide consensus is that we see the median estimate going up to pencil in effectively 2 rate hikes for next year. So the Fed funds rate projection should be around 62 basis points effectively for the dot plot. If they signal 3, then those people calling for 4 and above will feel validated in their position. They're obviously not going to go ahead of 4. So if they signal 3, that would be a surprise. I think the market will react. You're going to see those 2-year yields, which of course have had such a big move. We've gone from around 20 basis points up into really where the market's sort of cognizant or hesitant to sort of push it above 70 basis points. If we see 3, it would be a surprise for the markets. I think everyone's expecting 2. If 2 yields push above 70 basis points, that's then going to be the bid, I think, to really push the dollar higher. I've got the dollar index. You can see it's kind of breaking out of this pennant at the moment. The market is obviously buying dollars into the Fed meeting. Its position, I wouldn't read too much into it, but if the 2-year, which I think is really sensitive, the dollar's really sensitive to at the moment, if the 2 year is going to break above 70 basis points, because we're going to see 3, and that would be a surprise, and the dollar index is going to break 97, and it's going to continue a merry march into 100 effectively over time. The other one then is, I'll stop sharing my screen, is go to the dot plots for 2020, let's say 24. The call is, I think for a more bullish call, 2.37% would be pretty hawkish, because this would when we start signaling sort of 9, maybe 10 rate hikes over that period. I think the consensus is around 2.1%. So I think that would be a big issue there. Of course, we're looking for that taper program. I don't think we're going to see any kind of movement if they announce that they're going to accelerate it from 15 billion to 30 billion. I think that's widely expected by the market. If it was more, then that would be a real surprise, but I don't think it's going to happen. And then, like you say, we're going to finish the taper, the QE program in the end of March, and that'll open the door for what is really a rate hiking cycle, probably from around mid next year. But obviously, if equities collapse and we start talking 5-10% drawdown, then those rate hikes will be priced out. What were the 3 big ones you're looking for? Pretty much a similar situation there, which could move markets.
Identical to what you're looking at.
In terms of Luke, in terms of the Fed meeting, what are you seeing in terms? As traders, we always look at positioning, technicals, flow, that kind of those factors. I mean, I look at what's priced in to the money market curve, and we're looking for about markets pricing in between 2 and 3 rate hikes by the end of next year. So we need to see the statement obviously meeting that. But what are you seeing the risks for the dollar and those things going into the Fed meeting?
I think the risks for the dollar actually tilted quite hawkishly going in, and I don't think any other central banks, Bank of England from the other major G10 currencies, are going to be able to match that, particularly from the Bank of England. We may see an ECB hawkish surprise, but I don't think they're going to be able to match the hawkishness of the Fed, and that should still keep the dollar nicely bid. Although seasonality in December tends to weigh on the dollar a bit. I think, obviously we're living in a different world now, and you can't always base your decisions and tactical trades on historical precedent when things have changed so drastically. Positioning, net specs, it's not too chunky, so there's potential for that to build up a bit more, and that could act as a potential tailwind for the dollar too.
Yeah, I saw last week that the US dollar shorts, long positions have been pared back a little bit going into this. Maybe they've started putting back on. But I look at the CFTC reports and other flow sort of reports, and I think sentiment towards the dollar is pretty bullish. But generally speaking, a lot of those long positions have been pared back. So I don't think the market goes into the Fed meeting excessively long dollars. But I think people are quite concerned about tech. People are quite concerned around meme stocks, crypto, and again, we're looking past March of next year and saying, the Fed giveth. Now they're taking it back. What does the world look with less liquidity? So for me, I see the balance of risks for a stronger dollar from this, but I think it's going to be really what happens in the Treasury market is going to affect the dollar. And if Treasuries go higher in terms of selling, people push yields up, then the Nasdaq could come under pressure as well. So I think look at those dot plots, look at their view on inflation. How worried are they? And then that'll give us a sense there. I think the ECB meeting, let's switch gears now to one that you've been looking at very closely as well. I'm going to ask you the same question in terms of 1 to 10, 1 being it's not, it's a non-event, and 10 potentially for the world to implode effectively from what the ECB do with massive volatility. Where do you sit with this, with the potential for this being a vol event for traders? Obviously it's part of their risk management.
So for me, it's going to come in slightly lower than your estimates for the Fed meeting, and it's going to be, I'm going to pin it at about 6.5 to 7. That's on the basis that traditionally the ECB is fairly conservative, and they like to err on the side of caution, as opposed to the Fed. They've got weaker fundamentals in the economy. So I would say 6.5 to 7. But it is a really important meeting in terms of calibrating the extent of that monetary policy divergence, the theme for 2022. And there's a lot of different permutations in terms of what could potentially come out. I think the key factor that needs to be on traders' radars is what they do with their asset purchases. And that, I think, will drive the most volatility. We got those inflation forecasts out. They were leaked earlier, and we saw that they're going to be below 2%. I think, look, maybe if we get another...
Is that a surprise? What were they?
No, that wasn't a surprise. It was well, the market was well expecting that to be below 2%. I guess it's just below target, the actual words were, which is obviously 2%. I think, the surprise for the market, the only surprise for the market that will come on Thursday would be, most are expecting around 1.7, 1.8% for core inflation into 2023 and 2024. So I think if we were to see maybe 1.95% or 1.98, very close to 2, that might actually be a tiny bit hawkish for markets.
Yep.
And then the last factor that I'd have on your radar, which filters through into this volatility, would be basically how they talk about their rhetoric towards inflation risk skewed to the upside. We saw an influential member, Schnabel, actually talking about how she believes there's certain structural factors that could keep inflation higher for a few years to come. And if that's sort of echoed and spoken by Lagarde as well, and it shows more of a broader consensus within the governing council, that could also be run away with by some hawks on the euro, and the euro see a bid against crosses like the GBP.
No, I will mention, and you can see a chart here. 1 week euro dollar risk reversal. So this is looking at call volatility relative to or minus put volatility, and you can see that's positive. Effectively, what that's showing is that people are expecting, if there's going to be a move in the euro over the next week, it's going to be a bigger move, a bigger sort of a more aggressive move to the upside than the downside. It tells you that the markets are saying, on balance, over the next week, that there are risks skewed to a stronger euro. Now, I'm concerned, if I look at euro swaps and inflation expectations, they've come down. We've got real rates in Germany, pushing 2%, one of the lowest levels we've ever seen. So it's difficult to make a convincing play on the euro. But when we come to the asset purchase, I reckon that this is key, right? So just give people a guide in terms of that liquidity. So we've got the pandemic emergency program, which is due to expire in March. What happens to that? And then ultimately the asset purchase program, what's the base case for you into that? So let's just take the base case before we then go into where the market could move. So how does this actually unfold?
So I think base case is that they ended in March. However, because of the pandemic emergency purchase program, now the normal asset purchase program, APP, basically is running at 20 billion euros a month, and PEP is running at about 60 billion euros a month. So combined, you've got 80 billion euros a month currently that asset purchase are running at. Now, the hawkish surprise would be if they went to the cliff edge scenario, whereby they went straight from ending PEP and just went straight down to 20 billion euros with the asset purchase program. Now, I think that's not my base case. That would be the hawkish surprise. Base case is that they maybe beef up the APP to 40 billion euros a month, so half of what it's currently running at. So we get it's smoother transition for the market. It's less of a shock to the system, and we wouldn't see those BTB Bund spreads wide, and we wouldn't see yields jumping up. The problem, though, the only problem with the APP is that it lacks the flexibility like PEP in terms of deviations from the capital key. Obviously, if they have to purchase more Italian or Greek bonds or Spanish bonds, where yields are more reactionary to lower demand from a big buyer like the ECB. Reuters came out with an interesting article last week that an ECB source had been on the wires talking to them, basically saying that there were a number of scenarios. So let's go through them very quickly, right? They can kick the can to next year, where they don't give us any details on what they're going to do. They just tell us that it's confirmed that PEP's going to end, okay, in March. And then they make a decision next year, Feb sometime in the beginning of the year, as to how they're going to transition that period. But we don't hear anything now. The second is that they use 20 billion for APP. That's a hawkish cliff edge scenario. The third is that they use some temporary PEP recovery program in conjunction with 20 billion euros a month from APP, and that retains the flexibilities of the previous PEP program. It's a clever way that they can continue doing it. Now, they can either do that via creating a new envelope, topping up maybe 250 billion euros until the end of 2022, or they can basically use any unused funds from the current PEP program and reinvestments from that quite flexibly. So those are basically the options that they have in their toolbox. In terms of base case, I think if they do give us anything now, I'm leaning towards either they kick the can or they give us something now. I think basically they lean either to a topped up APP and don't care about the flexibilities, or we get 20 billion euros APP and we get a bit of flexibility from some PEP-like recovery program.
If there is going to be, if there's going to be a scenario where you're going to see a massive move in the euro, a stronger euro, and could be a spread widening situation, what is that one thing that traders need to worry about?
That's the cliff edge scenario, bread and butter. Yeah. That's what causes it, that they go from a sort of a steady pace of 80 billion, right, drop down to 20 billion euros a month. That's what, for me, does it. And then you've got the sort of supplemental factors, like if Lagarde echoes what Schnabel was saying about upside skew risk to inflation, and then maybe if we see those forecasts for 2023 and 2024 for inflation pinned much closer towards 2%, those would just be additional factors. But I think your bread and butter core driver would be the massive falling off in asset purchases that would drive yields, spark them higher, because the market would not be expecting that. And they don't expect that sort of behavior from the ECB, because as you say, the ECB errs on the side of caution. They like to play it safe. But, the median target for the euro US dollar for next year is kind of sitting at about 116. Now, for me, I take another view. I take a opposing view to that, Westy, and I actually see 110 as being much more likely being reached as opposed to 116. And for me, is that that's a euro US dollar chart there.
Well, I think you've got some consolidation now. We've had a downtrend. We're consolidating. I'm going to put some Bollinger Bands on there, but really the key level is obviously is 113.77. The implied move over the next week, if you look at implied volatility in euro dollar, weekly volatility is 8.6%. So that gives you about 105 point move with a near 70% level of confidence that it's going to sort of stay in there. So this is your key level there. If we do get that hawkish move, sorry to sort of
no, it's fine, Westy. Just keep that up, because I wanted to just indicate to anybody viewing this that also there's a bit of a descending flat-sided triangle that I drew in on my charts at about 112.5. We see the floor support there, and then we've got, if you connect that green candle high there at about 113.8 downwards, you've got a descending flat-sided triangle, and that technically usually it breaches that floor. The floor can't support it as you're making a series of successive lower highs. The floor gets breached, and for me, then you start looking at around that low that we saw back in around there. Yeah, exactly there. Just under.
Yeah, I think it's just difficult. I mean, the market is going to this. They're leaning short euros. If we get a break of this, then obviously I think this swing low here, 112.27 is key. You go to new lows in euro dollar on this run. But yeah, to get bullish, if we get a closing break of 113.82, then we go back into these sort of series here.
It's the one I'm most confident about from macro perspective, because I just think the structurally differing inflation profiles between the US and the euro economy should help underpin a multi-year divergence in monetary policy. However, there are some risks obviously to that view in the shorter term, but I think the longer term will be driven by that rate differential. The shorter term would be if there's risk sentiment sours on maybe some geopolitical tensions between Russia and Ukraine, or alternatively the COVID situation deteriorates, we get a new, more severe variant. And what happens is usually it's not because the euro is a safe haven currency. It's actually because we see an unwinding of the carry trade, because it's got such low interest rates that people use it as a funding currency to pick up yield elsewhere.
Well, have a look at this one. This is what I look at very closely. And I know we can look at real rates, but just looking at the difference between US 2-year yields and German 2-year yields, you can see that there's 134 basis points of 1.34%. Yeah, central bank divergence has been the big trade in 2021. I think it's going to continue into 22. Yeah, you can have a look at the difference there. If yield premium increases relative to what we're seeing in Germany and Italy, then what you'll see is the dollar rally. We can look at 5-year treasuries, go slightly further out the curve. We're at 182 now. if US Treasury yields in this part of the curve see something that they see from the Fed, what we're looking at ECB, whether we're looking at the Fed, this is absolutely key, this differential. If the ECB turns out to be more hawkish, then you're going to see this come lower. Effectively, that's going to put a bid into the euro. We're going to break that top side resistance. If the Fed meeting is considered to be more hawkish, more dovish, you're using this spread as your guide for euro dollar and the euro crosses more broadly. If US Treasury yield premium increases, we get through 190, then the dollar is going to continue to rally, and that central bank divergent trade continues to go forward. But I want to touch on the Bank of England. Let's sort of keep this let's keep this snappy, because I think the Bank of England meeting of the three is probably the least impactful. We've got 5 basis points of hikes being priced into swaps market for this meeting. So yeah, what's your call? And you know, if we are going to get a 15 basis point hike, then immediately you're going to see a pretty solid rally off the bat in the pound and the pound crosses, right? So yeah, what's the likelihood of that happening?
Yeah, I mean, as you said, 5 basis points, so that's a 30% chance of a 15 basis point hike, basically, the market's seeing. And it's a widely held consensus. I'm also of the view that we don't see a hike. I think the Plan B restrictions was basically the nail in the hiking coffin. And then, you know, on top of that, you had a leading inflation hawk like Saunders, basically also erring on the side of caution. And that really sort of threw me a bit off, especially as someone that originally, before Omicron, was expecting a hike for them to move. He was saying, let's wait for additional data on it. So I think this is clearly quite a patient committee who sees value in waiting for additional information. You know, it costs them less to temporarily be behind the curve as opposed to sort of, you know, jumping the gun and potentially then having to reverse it. And you've got to remember there's a lag between policy, between the implementation when visible effects become known. So yeah, for me, you know, I think it's that we're not going to see a hike. But as you say, if we were to see a hike, that would be a big shock to the market. The market is not expecting that. I think you'd see multiple sigma moves in the UK 2-year gilt. It would spike higher, the gilt yield, and that would see some strong demand and bids coming through for pound crosses. And I think the FTSE would also have a hard time. And just lastly, you know, historical precedents, they like to take action in conjunction with press conferences as well as monetary policy reports, which we'll have in Feb. And another interesting fact, which people may not know, is ever since the Bank of England became independent since 1998, they have never hiked at Christmas. They do not want to ruin the merry spirit of Christmas. They've never hiked into Christmas. So that's something interesting to note. And I think one thing that I'll be paying particularly close attention to try and maybe give me some clues for February will be, what does the interest rate vote sit at? Because last meeting we had 7-2, Saunders, Ramsden leading the hawkish charge. Does Saunders now, after his recent rhetoric, does he actually pull back and we have an 8-1 vote? Or do we actually even get a unanimous where Ramsden too takes a back seat and it's unanimously in favor of no vote? That could add a bit of pressure to the pound. So I think markets are positioned short, cable, GBP, US dollar going into this. And I think we get a real hawkish surprise if they hike, but I see that as basically
very low. Well, the market's paired back. We've gone from 135 in mid-November down to 130 into 130, 180 and we're just consolidating now. The market's sort of headed and pushes lower because it's repriced. But yeah, I mean, if they get a hike, which some people are calling for, I mean, I don't see it myself. I think Omicron's too much of a cloud over this market for them to do anything ahead of Christmas. If we were to get one, I think 132.80 is the key level there. I think we break that and perhaps, you know, close. But a lot really depends on whether it's just a one and done. I think the base case is that they leave rates on hold. You look at the mix of voters and they basically make an assessment. What does the statement say? You know, does this give us any clarity as to whether we get a February hike, which is nearly fully priced? But I think for me, trading the range 131.80, 132.80 seems like the likely trade in the short term.
But I think to finish off, Westy, let's just finish off with what our biggest trading themes for 2022 going to be, in your opinion, and I'll give mine very briefly.
Well, I think central bank divergence is going to continue. I think the US is going to be. I think the economy is going to do quite well in 2022. But my central thesis is that I think China is going to outperform. I think emerging markets are going to outperform. Which is a big call considering the Fed are going to be tightening. But I think China's going to do pretty well. I think Chinese assets are going to outperform, spending equities are going to outperform the US. but I think we're going to see high volatility in US equities. I think there's going to be end of Q1, there's going to be a material drawdown in the market. That said, I still feel pretty positive about US growth and global growth into 2022. But my main theme is central bank divergence. It's been the theme this year. I don't see it changing anytime soon. So looking at relative yield differentials and playing it through the currency markets and central bank divergence continues to my theme. What about you?
Yeah, I agree. At the heart of the pandemic, it was all about vaccine differentials, and now we've returned full circle to the real core of what FX markets are about, and rate differentials are now back in vogue. The one other thing I'd add to that would be, this interesting divergence in commodity land between oil and gold. I think once Omicron's out the way, oil is going to be real punchy, and I think gold is going to suffer. So there'll be a nice little divergence play between those two. And then lastly, I think geopolitical tensions, Russia, Ukraine, that's going to be a big one. The more minor one, obviously, being Brexit. Seems a bit calm at the moment now, but you never know. And then obviously closer to you, Westy, China and Taiwan. So there's a lot of volatility on the bone for traders to chew on. And I think we're looking forward to a very interesting 2022.
Cool. Well, yeah. So everyone, keep an eye on the Fed meeting. I think everyone's probably is. Make sure even if you're running an expert advisor and an algo strategy, just be aware that you do have a potential major volatility event, and that could affect that. It's going to affect the range expansion and your price action, and therefore your algo is going to be reactive to that. You've got the ECB meeting we talked about there. We talked about the risks, and obviously the Bank of England there. So anyone who's trading through this period, good luck. We wish you the best, and just be aware that there is some volatility on the cards there. So from Luke and myself, good luck to everyone out trading.
Good luck, traders.